Hi, my name is Dan McLaughlin, Chief Economist at Bank of Ireland. Well, the situation in the Eurozone has certainly, unfortunately, deteriorated a lot in recent months, partly due to the ongoing financial turmoil. That has had, I think, a big impact on business and consumer confidence across continental Europe. So I think it's pretty clear that activity there has slowed. The corollary, though, which is some good news for Irish households and businesses, is that that has prompted a significant change from the ECB. They raised interest rates, of course, earlier in 2011 twice, from 1% to 1.5%, but in November they reversed course somewhat. They cut interest rates by 1/4%, and we think that they'll probably cut again in December at their December meeting. And so at a minimum, I think we're probably looking to interest rates to go back down to 1%, where they were earlier in 2011. But I wouldn't rule them out actually going lower still, because ECB interest rates are still much higher than they are, for example, in the UK. They're only 0.5%, and in the United States they're 0.25%. So we're certainly looking for ECB to cut rates again, and as I said, interest rates to go lower. So anyone on a tracker related to borrowing costs will certainly see the benefit of that. The Eurozone is performing poorly, but in contrast, we're seeing some better than expected figures in other major economies, most notably the United States. Their economy picked up in the third quarter. Looks as if the fourth quarter will be something similar. So I think as we move into 2012, we're seeing a significant divergence where the United States is performing reasonably okay, but the Eurozone isn't. And I think something which will fall out from that is that we will see downward pressure on the euro. Our own view is that probably against the United States dollar, the euro will end the year at 130. Having been up as high as 145 at times earlier this year. And I think there's a lot of downside risk for the euro. Probably fall a little bit against sterling as well, but maybe not as much. We'd probably see it around 85 pence. So I think for small businesses that are exporting to the UK, or particularly into a US dollar related market, I think they will benefit from a weaker euro, and I think the risks are certainly for a much weaker euro rather than anything else. Inflation in Ireland has been a problem over the last year or so. It's picked up significantly, partly due to higher energy costs and partly due to higher mortgage costs. And we think over the next year that inflation will fall back significantly. The ECB, as we know, are not going to be raising rates further in the short term, and have obviously started to cut rates. So I think mortgage costs will not be rising significantly next year, and may well fall. So that will put downward pressure on inflation. As we've been saying for some time now, it's pretty clear that the Irish economy is very much, split right now. You have the export sector, which is doing fairly well, and the domestic economy doing relatively poorly, and particularly the consumer has faced a lot of headwinds. So particularly higher inflation. So if inflation does indeed fall next year, that will certainly help the consumer. And I think the other thing to keep an eye on is the labour market, because over the last 3 years we've seen a massive fall in employment, of course, in Ireland. Irish employment has fallen by around 300,000. But in the second quarter of the year, the fall in employment was only 3,000 in the quarter. So it looks as if we might be around a point where employment stops falling. If that is the case, of course, I think even if the rise in employment is very modest, which we would expect it to be if we do get a rise, I think that still will be significant change in sentiment. And if we saw employment picking up a little bit, and if we saw the unemployment rate ticking down, I think that would certainly boost consumer confidence.